Okay, we have two questions here on special pricing. It's a little bit better, huh? It's pretty dark. We've got this product A is normally sold for $9.60 per unit, and a special price of $7.20 is offered for the export market. The variable production cost is $5 per unit, and an additional export tariff of 15% of revenue must be paid for all export products. So assume that there is sufficient capacity for the special order, that's good, and prepare a differential analysis. So we have special price is $7.20, and we got to pay 15% on it, which would be $1.08. That would be the tariff. So the selling price is $7.20. That's what we would get, and we've got variable cost of $5 and a tariff of $1.08. So we'd still make $1.12 on it, and based on this, you would accept the order. Okay? That's it. That's sort of a straightforward problem because there isn't any fixed overhead in it, but it's still okay. All right. The tariff would definitely come out of there though because you'd have to pay it. Any cash that's coming out of pocket, you want to make sure that you're covered by whatever your selling price is. Okay. Now on the last one. Okay. This is the portable power company expects to operate at 80% of productive capacity during July, and the total manufacturing costs for July for the production of 25,000 batteries are budgeted as follows. So we've got direct material, direct labor, variable overhead, and fixed overhead, a total manufacturing cost of $375. If they're going to operate at 25% of capacity, that would mean that they're going to produce 20,000 units, which is good because we're looking for a special bid here for 2,500, so we'd have room in the capacity to pay for it. Okay, so the company has a chance to submit a bid for these batteries to be delivered by July 31st to a government agency. And if the contract is obtained, it is anticipated that the additional activity will not interfere with normal production during July or increase any other expenses. Okay? And the question then is, what is the unit cost below which Portable Power Company should not go in bidding on it? In other words, what's their bottom line? All right, the absolute lowest cost they can get. So, genius that I am, I took the total here. Direct material, direct labor, and overhead, and I divided each one by 25,000. I could have added it up and divided it by 20,000, but I thought this was harder, so I would do it this way. My cost per unit is $6.50 and $2.80 and $1.20, which is a total of $10.50. Okay, so that would be all variable cost out of pocket, and it's absolutely the lowest bid that they could put in to cover their fixed costs. And then they'd have to try to, save some money here and see if they could get one of those cheaper so they could make some money on it. I worked in construction for a while, and we bid jobs in all over the world. And one of them was a convention center in Russia. At the time it was Russia, it's the Soviet Union. But what we bid it at cost, and then we would make all of our money on the change orders. Okay, because nobody ever sticks with what they want, what they initially ordered. So every time they would change something, that's where we made our money. So, for what that's worth. Okay.